In this video, we will walk through how to do the stock valuation. Do not view this as an example of the paper, but rather an outline of the paper, hitting the main issues you need to discuss, making sure you give your own opinions. I'll raise some of the issues, but you have to come up with your own opinions, provide your own analysis and support for your positions. And the stock we'll be using in this example is Walmart. Its ticker is WMT. And so the value of stock, we need to do two things. First of all, we need to come up with the discount rate for the stock. Once we have the discount rate, we can then use the valuation models, the dividend discount models, to actually come up with our valuation. So the first step we need to do is determine our discount rate. And I'm going to use the capital asset pricing model, or CAPM, which states that the discount rate for a stock, or KE, equals the risk-free rate plus beta times the market risk premium. The market risk premium is also known as the equity risk premium. And in shorthand, it's RF plus B times MRP. Which means to get the discount rate, we need three inputs: the risk-free rate, which is generally the 10-year Treasury, but as we know, there's an issue there because that rate is historically low right now. We need a beta. We talked about that in class. We'll do that last in the discount rate determination. And then the market risk premium. We also talked about that in class. And the key on the market risk premium is determining what theory you're going to use to come up with it. So we'll start with coming up with the risk-free rate and market risk premium, and we know that the risk-free rate and market risk premium are closely tied, especially when using the implied approach for determining the market risk premium. So what do I mean by that? Well, the implied approach is just one approach for coming up with market risk premium. Other approaches are the historical approach, which looks at historical returns on stocks and compare that to bond risk-free rates. There are other approaches uses corporate bonds, use the volatility index, but the implied approach is probably the most popular approach today and is frequently used by most asset managers in trying to determine the value of a stock. The implied approach says that the expected return on stocks overall, the entire stock market, what we can expect stocks to return, will equal the current dividend yield plus expected earnings growth. And if the expected return on stocks equals that, we also assume that the expected return on stocks should equal the required return on stocks. What investors expect stocks to make in the future should be what they require them to make in the future in order to compensate them for risk. And so if the expected return on stocks is the current dividend yield plus expected earnings growth, and we expect, or we believe that the expected return on stocks should equal required return on stocks if markets are efficient, then what we can do is forecast what we think stocks will return in the future by coming up with our own assumptions for the current dividend yield and expected earnings growth. We then get an expected return on stocks. That becomes our the required return on stocks. We subtract the risk-free rate from that, and that will give us the market risk premium. So what we're saying is the market risk premium should equal the expected return on stocks minus the risk-free rate. So how do we come up with the expected return on stocks? Well, first, the current dividend yield is whatever the current dividend yield of the stock market. Here's a place where many students make a mistake and they use the dividend yield on their particular stock. But remember, when we're doing the risk-free rate and market risk premium, it has absolutely nothing to do with your particular individual stock. Instead, you want to look at this as it is implied for the entire market. So what is the current dividend yield of the stock market? Well, we can go to Yahoo Finance. And a good way to look at the total stock market is to bring in the SPY, which is the exchange traded fund on the S&P 500. We bring that up, and it shows us that the current dividend yield on the SPY is 1.91%. So we can use that 1.91% as the current dividend yield. I'm going to round up to 2% because we're using fairly round numbers in these broad assumptions. And then the expected earnings growth, I'm going to say should be a function of nominal U.S. GDP growth. As we saw in class, that is a function of productivity, labor growth, and inflation. And here what we can do is you can actually go in and use the file that I provided to the class under miscellaneous materials and just find economic growth components. And if you'd like, you can actually bring that file in and copying that graph into your paper if you like to give yourself support for what you think long-term economic growth for the U.S. should be. And in that case, that also means what you expect growth in stocks to be. Let's see if we can copy this in. I don't know if this will work, but we'll try it. I'll try to paste it as a bitmap. Let's see how it comes in. It's a little large, but we can shrink it down some. My mouse is not in a great spot, but all right, so if we look at this, we can see productivity growth. If you look at the graph, it's a little small on this screen, but if you look at the graph, you can see productivity growth. 2% has been a pretty good number historically for the U.S. Employment growth has been anywhere from negative or 0 to 1%, and inflation has been anywhere from 2 to very, very high in the 70s. But the goal is, what do we expect going forward? And so I'm going to say productivity of 2%, labor growth of 0.5%, and inflation of 2.5%, giving me a nominal GDP growth of 5.05 or 5%. So I expect the U.S. economy to grow about 5% over the long term, 2% from productivity, 0.5% from labor growth, and 2.5% from inflation. Which means I expect earnings growth in the U.S. to be about 5%. So my expected return on stocks, I believe, to be 0.02, the current dividend yield, plus 0.05 nominal GDP growth, or 7%. So if I expect stocks to return 7%, then what I can do after this is I can now come up with my risk-free rate. And remember the debate here with Dr. Damodaran. I gave you an article on that, so you can use that article to come up with your own position. My debate here is the current 10-year Treasury, in my belief, I'll say it was artificially low, so needs to be normalized. That's my position. Dr. Damodaran's position is it doesn't matter if it's artificially low, it is the risk-free rate, so use that rate. If you use my approach, you will normalize it. You'll have a higher risk-free rate, which means you'll have a lower market risk premium. If you use Dr. Damodaran's approach, you will have a lower risk-free rate and a higher market risk premium, because the two of them, remember, must add up to 7%. If you're using my numbers, whatever numbers you're using, it must add up to what you think the expected return on stocks is. The argument I'll make for my approach is if you use the current very low 10-year treasury, that implies a very high market risk premium, but I do not see evidence for that. For example, the volatility index, also known as the VIX, is actually currently below average, not above average. So I don't see evidence that the market is particularly worried about risk. This is video 1, and next video I'll talk about how I normalize the risk-free rate. If you use Dr. Darren's approach and use the current 10-year treasury, then you simply need to go get the current 10-year treasury from Yahoo Finance, which is very straightforward to do, but you still need to discuss in the paper why you believe you can use the current 10-year treasury given how low it is. You need to address the issue of the current 10-year treasury being so low.